multiple fuel price hikes, a plunging rupee, higher duty on gold and silver, and the Prime Minister appealing to citizens about what they need to do to help the country. Now, that's been the India story for the last few days. Now we know the context against which all this is unfolding, which is the crisis in Iran. But that still leaves us with a lot of questions. For instance, what's the extent of the situation the Indian economy finds itself in today? And is the crisis in Iran the only significant factor, or are there more issues at play? To unpack and understand all of this and more, we are joined today by Dr. Ajit Ranade, economist and columnist. But first, whether it's decoding an economic crisis or covering the assembly elections, none of it is possible without supporters and subscribers like you. So do consider supporting independent journalism, scan the QR code on your screen, and consider becoming a subscriber. Thank you so much for joining us, Dr. Ranade. Now, over the last few days, we've seen multiple things happening, including the fuel price hikes, multiple fuel price hikes, the import duty on gold and silver being hiked. We've had the Prime Minister appeal to citizens about what they need to do, and a bunch of other things as well. So we'll get into some of that in a little more detail, but I want to start with asking you, Dr. Ranade, are we facing an economic crisis, and how is that likely to unfold in the coming weeks?
I don't think this is a full-blown economic crisis or the balance of payments crisis that we faced in, for example, in 1991. It is not as severe a situation as back then. But it is true that we are facing a challenging economic situation on multiple fronts. On the currency front, because the currency under pressure and it is sliding. On the current account deficit, there is the shortage of dollars. On the outflow of dollars through the stock market or otherwise. On the creeping inflation, both wholesale prices and retail prices. And on the investment stagnation or slowdown. So, and then of course there is the prospect of an impact of El Nino on agriculture. So it is not a crisis, but since there are multiple factors, and if they're all coming at the same time, it can be an extremely challenging situation for economic management.
All right. And how do you see this playing out in the coming weeks?
Yeah, so it is something that calls for action to kind of provide some resilience to the economic challenges. As I said, it is not a crisis, but then, there are no sharp definitions of crisis. Our standard benchmark is what happened in 1991 when the foreign exchange reserves were pretty much down to zero. So that's not what we have. So what is to be done? So we should first take stock of where we are in terms of what strengths do we have, how is the economy in terms of how strong it can withstand the challenges we are facing. So on one hand, our stock of foreign exchange is roughly $650 billion, enough to pay for 10 to 12 months of imports. So it's not an immediate crisis. Then our GDP growth rate, the aggregate economic growth rate, is still holding at around 6%. And that's, even if it slows down, maybe 5.5%. So it's not zero or negative. We are not in a recession. Then if you look at the inflation rate, of course, it has inched up. But the latest data from April, I think, is showing something like maybe between 3 to 4%. The wholesale price index, which is something which producers face, not consumers, that has gone up to 8.3. So it's higher. Still, we are not nowhere near the double-digit inflation that we experienced in 2012, 13, around that time. So each of these things, petrol prices, fuel prices, of course, they have gone up to 100 rupees a liter or 110. Again, this is something we have seen before, but so these are, when you look at this, it shows that the economy is in a shape where it is able to withstand at least some of these challenges. But what is to be done is that we have to ensure that we take steps so as to be able to uh, protect ourselves from the inflationary forces to the extent possible, protect ourselves from the sharp movement of the currency, that is the sharp depreciation of the rupee with respect to the US dollar. We need to find out how we can retain and attract investments, especially from the foreign private investments, whether in the stock market or even in the economy. So these are the things that we need to do. Some of them may require short-term or immediate response. Some of them, of course, will require medium-term, longer-term. They won't take effect immediately. Whatever we do, you can see the impact of that over several months or a year. So there are multiple things that we need to do.
You mentioned foreign capital, of course, and that's something that's being discussed at length. It's not something that's happened suddenly, but it's been highlighted because of what's been unfolding in Iran. Could you take us through what is the situation right now, and why has this flight of foreign investment been happening? For instance, we had the investor Ruchir Sharma say that it's India is not able to attract this kind of foreign investment because it doesn't have a strong AI story. So is that is that one big reason? Are there multiple factors?
Yeah, so this is a fairly important factor. So let me dwell some more on this. So as you know, India is probably one of the only large country, especially in this region of East Asia or Southeast Asia, which consistently has a deficit on its trade account, or what is called current account deficit. What I mean by that is our import requirements of dollars is more than our import requirements is more than what we earn. When we are importing stuff, we have to pay it in dollars, in a foreign currency, and the only way we can pay for the dollars is if we earn those dollars by exporting stuff. And of course, we can use some of the foreign exchange stock that we have. We earn foreign exchange by the sale of merchandise goods, that is called things like petrol and diesel refined products, which we export, or manufactured products, industrial products, textiles, leather products. But we also, as you know, have a significant export called software services. So it's not only manufacturing, but also services. And we get a significant amount of earnings, dollar earnings, from what are called remittances. We are the world's highest earner of remittances by far. And we have been number one for the last almost 20 years, far ahead of other countries like Philippines. Earlier, it used to be China also, but we are far ahead. This last year, we got $135 billion worth of remittances. This is money, dollars, which is sent home by Indian workers who are working in different parts of the world. Software earnings has earned something like $200 billion. So these are big amounts. However, our import requirements are much higher, $600 billion. So there's always a shortage consistently for the last 4 or 5 decades. And that shortage of dollars is paid for by investors. So this shortage of dollars, we are able to pay for that because dollars come into the country in the form of either loans, foreign loans, that is, or more importantly, investors who put money in India. They put money into the stock market, or they put money into greenfield, factories and investments on the ground. So if a foreign company is setting up a steel plant here, or a foreign company is setting up a textile park, or maybe something in manufacturing, or a foreign company is setting up a software operations here, all these are all foreign money which is coming in the form of investment flows. They are different from export earnings. These are investment flows. They are called capital flows. So what has been India's story is that all our deficit on the trade account is more than offset by what comes in the capital account. Now that story is fraying, or is weakening in the last 3-4 years. It's not recent. It's not just this year. Last 3-4 years, we are seeing steadily that the net foreign investment that's coming into India is steadily declining, and it's close to zero now, by the way. Now, there are two parts to this. There is outflow of capital and inflow of capital. So actually what is happening is the gross inflow of capital is still strong. For example, last year, almost $88 billion of gross FDI, foreign direct investment, came in. But the outflow has been increasing. So this is foreign money, that is dollar money, leaving in India, either in the form of outbound investments, Indian companies making investments abroad, or Indians buying assets abroad, buying land, or going for tourism, or paying for children's education. So all of that is now a significant outflow. I mean, I don't have the exact numbers, but basically, if $80 billion are coming in, more than $80 billion are going out. So the net is zero. And that's the worrying part, that we have to figure out how to increase the net FDI flow. Because if we don't get enough net FDI, then our trade deficit will widen. As I said, the current account deficit, that is the shortage of dollars, and that will put pressure on the exchange rate. That will put pressure perhaps on other aspects of the economy. So there we need to find out. I mean, so it is one thing to attract more foreign investment into the country, and another thing is to figure out why is the outflow of dollars accelerating. What is the reason that the outbound investment is accelerating? Now we need to. This will require a much more granular analysis.
This, of course, takes us back to the Prime Minister's appeal, first and second bar about 10 days ago, where he was essentially telling his fellow citizens to not consume imported goods, which is, whether it's fuel, whether it's gold, and also to not spend money abroad, which is why he said, don't have, avoid destination weddings, avoid foreign travel for a year. So why was he focusing on this particular aspect? Of course, he couched it in very different language, in the language of patriotic duty. But why was his focus on this?
The root of all that is dollars. Let's be clear. It's not about gold per se, wanting to stay away from gold. It's not that he doesn't want people to do foreign travel. It's not as if you don't want to use fuel or transportation. All of these things, because last year India's import of gold was $72 billion, huge, and India's import of crude oil, which is converted into petrol and diesel, was more than $150 billion or 130, huge. Foreign travel, I believe outbound foreign travel is something like 15, 17, $20 billion. All of these things require dollars. And where do the dollars come from? I told you, the dollars have to come from our foreign earnings, that is export earnings. But if the export earnings are falling short, then they come from capital flows, that is foreigners putting dollars into India in the form of investment in the stock market or as direct FDI. But you know what? In the stock market, the story has been very, very grim. The foreign institutional investors, that is people who put money in the stock market, they have actually pulled out. They have taken out $40 billion, $40 billion in the last 1.5 years. So relentless selling by foreigners, taking away dollars out. So the Prime Minister's appeal has to be seen not directly in terms of gold or foreign travel or transportation and fuel, burning fuel. It's actually because we have a worrisome situation about the rapid depletion of dollars. Because if outside money is not coming in, we'll have to depend on our own stock, and we have a comfortable stock, maybe $580 billion, but that may not be enough if the crisis worsens. And remember that our own foreign exchange stock has what we call foreign exchange stock has a big component of gold. The gold value has gone up, so you can't use that. So if you take that aside, then the actual amount of dollars is not that comfortable. So that's the root of that's the reason the Prime Minister is appealing that conserve dollars. I think it should be understood that way.
But I was also curious about how effective this kind of appeal for austerity measures is, especially is it fair to place that burden on citizens essentially? And apart from generating photo ops, we've seen now a lot of ministers carpooling or reducing cavalcades or going on motorcycles, etc. But how effective is this going to be?
So there are two angles to this. One is that, as you said, optics. That you can't. You have to consider the equitable aspect of it. That is, you can't expect people to cut down on their LPG, cooking gas, and their transportation to go to office, whatever vehicle you use. when in fact they are seeing that there is no cutback. If they don't see any cutback on public officials, for example, foreign travel or ostentation, other display of that there is no cutback there, or the luxury consumption of the richer segments, then it's that's one angle that it doesn't appear to be equitable. And then, as you said, it may be, is it only just a photo op? Uh, the other angle I think we need to consider is that let's not only talk about austerity, let's also talk about how can we attract more dollars, because the whole thing is arising out of shortage of dollars. So if anything, if you cut back, in fact, that may have an adverse impact on consumption spending, which actually might, in fact, ave- affect the GDP growth also, maybe detrimental. But therefore, while we are addressing the shortage of dollars, uh, only austerity is not the only way. We need to think about how can we attract more dollars into the country. And there is a third angle also. A third angle would be that sometimes it's behavioral, it's psychology. If in fact people start thinking that he's asking us to cut back on dollar, purchase of gold, or there's a stiff import duty on gold, they may actually conclude that the situation is much worse than what the government is telling us. And that may lead to even further panic buying of gold, because gold is seen as a secure value against inflation. It's a store of value. It protects you against. It's a very liquid collateral. You can get a loan against gold only. So that's the third angle, that sometimes the psychology may work in a reverse way, that people may think, oh, wait a minute, the situation may be worse. So they may lead to like panic buying, which is not what we want.
Yeah, because I think we saw people rush to gold shops immediately, after the first appeal by the Prime Minister, which was completely counter to what they intended. The other issues that's, of course, been grabbing headlines is the decline of the rupee, which, every day we're seeing. What does this fall of the rupee actually signify? How should we be looking at it? Beyond, I mean, obviously, it's an opportunity for political parties to say, oh, look, it's fallen again. But what does it actually mean for the economy?
So normally a fall of the rupee might have indicated economic weakness, but we actually have GDP growth, which is okay. Inflation, which is not too high, it's rising, but not too high. Our the deficit on the trade account, what is technically called the current account deficit, is sort of manageable. It's nothing extraordinary. So despite these macro signals being okay, if the rupee is rapidly sliding down, something more serious is going on. I think what that means is that our capital flows, what I said, the foreign direct investment or foreign capital that comes into the country, that is where the problem lies. Investor confidence, the ease of doing business for the our foreigners not coming in or packing up from here because of investment climate. Just a few days ago, we had this announcement that finally Tesla has decided to abandon its plans to set up a manufacturing factory in India. Some time back, we had Whirlpool, the famous washing machine and white goods company, scale back its investments. Yeah, I can give several examples. So, uh, so so the issue is not on the fact that GDP growth is okay or inflation is okay, sort of okay, and uh, the current account deficit is not so worrisome, not alarmingly high. It's the other things. What is happening on our oil security? That is strategic petroleum reserve, what is called SPR. What is happening to foreign direct investment, the net foreign direct investment? What is happening to our capital account? What is happening to our balance of payments? So it's there where all this uh, rupee story is hidden, or it's not that suddenly what happens if it's an inflationary economy, the purchasing power of your currency is loses value. Like if I have 100 rupees in my pocket and if the inflation is very high, by the end of the year the 100 rupees is worth only 80 rupees because inflation has eroded the value purchase. That's not what's going on. It's the fact is the external value of the rupee is sharply lower because of these influences. The capital flows are drying up, and our oil we have vulnerability on our oil security. That is, other countries like European Union, all of those oil-dependent economies, they build resilience through large strategic petroleum reserves. That we haven't built up as much as we need.
Should we also be looking at more, for instance, fuel hikes in the coming days? I mean, now that there was a report today about the possibility of more restrictions on imports. So, is that something that citizens should brace for?
Yeah. So now, apart from the currency story, the exchange rate story, now we are talking about the impact of the oil price spiking up globally. So when oil prices go up because of the situation in West Asia, first, the moment crude oil prices go up, I mean, they've gone up from 70 to $100, which is almost a 50% increase, 40%. What three things happen. One is that our current account deficit, that is our dollar shortage worsens. The deficit widens because we have to pay more dollars for import. Secondly, because these are, the crude oil is refined by the petroleum refining companies, oil marketing companies like Indian Oil, Bharat Petroleum, Hindustan Petroleum, and they sell petrol and diesel at the petrol pumps. They take a hit because they have not been allowed to raise the. I mean, until recently, it was still the price had not gone up, which means that they are paying more for the raw material crude, but they're only earning the same amount. So I believe in their losses mounted to 1 lakh crore rupees. That's just the losses in the first 3-4 months. So first thing that happens is the current account deficit widens. Second is the losses are mounting for the oil company or the oil refining company. And thirdly, eventually it's going to feed into inflation that in the economy. I mean, because transportation costs and all that. And the fourth, of course, is that if the government continues to suppress prices on LPG, then the subsidies will rise, fertilizer subsidy, all of it related to oil and energy prices. So the fiscal deficit, the government's burden may increase. So these are multiple things that happen when dealing with this oil price situation. So uh, some pain has to be spread around. Some of the pain will go to oil marketing companies, so their profit margin has to come down. Secondly, the prices at the petrol pumps have to rise. So some pain has to now be borne by the consumers. Thirdly, the fiscal deficit will widen because some of the subsidy expenditure on fertilizer and LPG and all will increase. So it's like trying to make a balance how to spread this pain. Eventually, of course, it all comes to the taxpayers. I mean, when we say government is bearing its subsidy burden, eventually, indirectly, it's actually taxpayers. So, but at least in the short run, what it means is that spread the pain between oil marketing companies' profit, their balance sheet, consumers paying at the retail petrol pumps, and subsidy burden of the government.
Finally, I wanted to ask you, Dr. Ranade, if the crisis in Iran were to be resolved, say in the next month or in the next couple of months, but how long will the recovery take for India, and what should the government be focusing on, especially to safeguard the interests of its weakest citizens?
So let me answer that question in a couple of ways. That how are we going to deal? The even if there is a ceasefire, first of all, we don't know when the ceasefire will come and whether it will be a very clearly defined. Sometimes it just drags on. So even if there is a ceasefire, the insurance premium of shipping lanes has actually gone up. So what is called the risk premium, the geopolitical risk premium, those prices have gone up. So it is not as if after ceasefire we'll go back to a pre-war, situation. So oil prices may remain high, but the risk premium that you have to pay on shipping risk insurance and all that will also be higher. And there is also people have had to change their supply chains, the routing, the logistics. All that is going to add to the cost. So this inflationary situation will be there. Secondly, remember that there are effects which we did not anticipate. So, for example, there is a story that the Tirupur textile, some companies there who were exporting textiles, and they had to depend on some critical imports from China, polyester, filament yarn, and so on. So they arranged for all that, and even though they had to pay higher prices and their profit margins were lower, but what they did not anticipate that all their workers did not have cooking gas, so they couldn't cook food. So actually, many workers left to go back to their villages. Now, this is a challenge which was not anticipated by some of the manufacturers there. Another example is where, uh, let's say, India is trying to build resilience by investing more in solar energy, so that our energy mix should go away from fossil fuels. And we have been doing that. We are the world's leader in the solar alliance. But what we have to deal with is that the batteries, I mean, even the components of the solar fabric systems, are the batteries that you need to shift to electric vehicles, need minerals like lithium, cobalt, nickel, even processed silicon. All that is still, we are critically dependent on imports from other countries, especially China. And it's not just the mineral, the processed, a country like China has only 10% lithium of the world, but they have 60% processing capacity. And there are many other items on which there is critical dependency on China. So, to answer your question, that what happens after the ceasefire, and if and when it comes, we are going to deal with these difficulties. There are difficulties of second order effects. There are difficulties of higher costs due to disruptions in shipping and geopolitical risk premium, insurance costs. And there are difficulties on import dependencies. And there have been instances where the Chinese have decided that they're going to halt certain export of critical minerals, and they have weaponized some of these things, maybe for reasons of their own security, in the sense of their own commercial interests, or perhaps for other reasons. So this is the year which we have to deal with the fallout of the West Asia conflict, plus the second order effects of inflation and supply chain disruptions, the pressure on the currency. And then to top it all, again, there is this anxiety or some apprehension about El Nino and impact on the Kharif crop.
So we're looking at a very difficult year ahead, even if and when the ceasefire were to happen. But thank you so much, Dr. Ranade, for joining us and helping us understand what this landscape looks like.
Thank you. Thank you very much.